We're in Denver, Colorado at EnerCom's 19th annual Oil and Gas Conference. I'd like to welcome Eric Dain, the Senior Vice President of Corporate Development of Enerplus Corporation. Hi, Eric.
Hi, Claire.
Enerplus recently reported production increases in the second quarter from your assets in the Williston Basin and in the Marcellus. With widening differentials in the Marcellus, how is this impacting your business?
The growth in the Marcellus for industry and for Enerplus has been tremendous. Enerplus, in fact, is projected to double its production in the Marcellus year over year. In the first half of 2014, we doubled our funds flow, our net operating income, from Marcellus production versus the first half of 2013. With the growth of companies like ourselves, like Enerplus Corporation, and industry, the takeaway capacity out of the Marcellus has been unable to keep up. As a result, differentials versus NYMEX at Henry Hub have widened. The impact and the implications? So far, we've balanced the supply growth and the takeaway. There are projects planned over the coming 3-year period that will continue to provide incremental takeaway up to roughly 10, 11 BCF a day. And it is that balance that will continue for the next foreseeable future 2 to 3 years as we measure production growth for companies such as Enerplus Corporation and others in the area and the takeaway capacity. It could mean that there's some adjustment to capital programs. At this time, that isn't the case.
Eric, you've got the state of North Dakota and the governor talking about curtailing oil production to reduce flaring. What do you see as a solution?
When you look at this, without question, everybody involved in North Dakota has the same common interest. That is to recover all of the associated natural gas and natural gas liquids, both for environmental reasons and for revenue and royalty reasons. So we have the same objective, but in a new, highly productive field where you're adding a lot of production month over month, it's difficult to always balance the infrastructure build and the production. So North Dakota Industrial Commission has set a target of 74% recovery by October 1st, and they'll begin to audit producers' supply balances effectively 2 months after that to test. I can't say what all of industry is doing to ensure that they meet this requirement, but I can say what we're doing. So at Enerplus Corporation, we have 84% of our wells tied in as of today. But the new wells we bring on are so prolific, they're so strong in terms of their production, both of oil, of course, and of associated gas and natural gas liquids, that it can change the balance of how much you recover just by one incremental well coming on. So what do? We manage our scheduling to ensure that we aren't exceeding the level. We work very closely with our midstream partners in this to make sure that our schedules are working with their schedules. And on occasion, we have to assume some inefficiencies. We can't do 7 wells on a pad and bring them all on the same day because it will push us over that limit. We think it's achievable and to meet their requirements, and we do not believe it will impact our measured growth that we see in this area.
Enerplus has improved productivity through completion enhancements. Can you talk about that?
Yes, in North Dakota we've made significant changes in the last 2 years. 2 or 3 years ago we were completing for roughly a 2-mile horizontal lateral, 28 stages, ceramic proppant, and putting in about 270 pounds per linear foot of proppant through roughly 1 entry point per stage. Where have we gone to? We've gone to roughly 40 stages, white sand, 1,000 pounds a foot, so a factor of 4 in terms of the actual proppant placed, and we've seen a significant change in our completion impact. What used to take 12 months to accumulate a certain volume of oil, we are now achieving in 3 months or less with these new completions. Now, will our completions continue to evolve? Without question. That's the nature of the business.
Eric, can you talk about your balance sheet and liquidity? How do you folks plan to fund growth going forward?
Certainly, Quinn. We have always maintained a strong balance sheet at Enerplus Corporation. It's fundamental to who we are. We exited Q2 2014 at a debt to funds flow of 1.3 times. In fact, we have virtually our full $1 billion bank credit facility available to us right now. Sustainability, that is your ability to continue to fund your capital program and your dividends, is something we are very focused on. Our dividend payments currently are roughly 25% of our funds flow, a very manageable level. And the organic growth we have in our portfolio can be fully funded by our cash flow growth without raising equity.
Well, we sure appreciate having you here, Eric, and all the insight you've given us.
Thank you for your time, Quinn. Appreciate it.
Thank you. I'm Quinn Nguyen for oilandgas360.com.